Yep. We're live. Mic check, mic check. Good to be back. Honestly, I have no idea if anyone is watching or is around. But I'm just gonna get started. I skipped a couple of these last week, Thursday, I think, and Friday, if I'm not mistaken. One of our floor traders, unfortunately, lost someone very close to them, and it just felt necessary to go show some support and love, etc. So we actually shut down the trading floor end of day Wednesday, and yeah, only restarted things yesterday, I guess. Half the team is still in Cape Town. Basically, no one is really gonna do much of work in the office this week. It's just me back here to man the ship. Wow, we're a small knit family. Anyway, it's good to be back. Hope you guys are doing well. Hope you guys have been trading well. I hope these morning sessions are beneficial, to you. And specifically in a very specific way. I hope that when they are not available, that no one is paralyzed and no one doesn't know what to do. And it's kind of like what I want to address today. All right. So today, please just be very mindful of the fact that I'm gonna do our usual morning stuff, but it's gonna be a little bit different. And I just want to focus on two or three charts today, fundamentally because I actually want to make sure I build the tools properly for you to be able to fully find these movements on a day-to-day basis by yourself. And I think that is all we're going to need. My worst fear is obviously becoming a crutch. I love what I do. I love doing this kind of stuff for retail traders, right? For individuals. Most of these ideas are generally specifically for 365 students. But over the weeks, months, there's been a lot of room for the public as well. But this is just to make sure that we're all clear on what needs to happen when I'm not around, right? So we're gonna do our usual routine. We're gonna look at the sentiment. I haven't checked on the sentiment, guys, since yesterday. I've been back officially since yesterday, and I just looked at price. I looked at all my charts. I looked at my accounts. I looked at my P&L. I was happy with where I am. I was moving stop losses around, locking profits, but nothing. I know nothing about the war. I saw a tweet about Elon Musk challenging Putin. I don't know if that's a meme or a joke or what. I didn't want anything to kind of like filter a price. And once in a while, remember to do that, especially for you guys. And I say you guys, I'm talking to intraday traders. Remember to filter out the noise every now and again. See price for what it is. See price before the war, because you're gonna have to see price like that after the war, and you need to see price like that during the war, because it's all about supply and demand, but specifically sell high, buy low. Smart money hasn't changed. Wall Street guys wake up every day to do the same thing. All right. So let's kind of like just look at some pre-market stuff. So I'm literally going to catch up on the world today just a little bit. I really don't care anymore about sentiment as well. I care enough to teach you about it. I care enough to kind of like tell you, right, like what's going on. Today and tomorrow is a big day, right? Fed is supposed to do some rate hikes, right? But all this information, I don't want us to overload our morning session. I can only be with you for just about an hour. So at 10:15, I will exit. Okay. So, but I will do a war room this afternoon, and in the war room, I'll break everything down. All right. So the Fed rate hike, how I think markets are going to move, the dollar run that we're seeing right now in the markets, etc., will all be covered in the war room, right? But anyways, our indices, the futures market down. There we go. There's someone on my Facebook page, on the 365 Facebook page, who said, I'm dreaming if I think NASDAQ is ever going to come to, I think, below 10K or a certain amount or whatever. It's one of those people who are just extremely biased, right? So when you've become so biased in price, it's when you have just one perspective and you don't learn about your asset. Oil, I hope people remembered about this oil target, right? Oil is now really, really, really getting ready for a soup. A lot of people bought in very high. You know the usual stuff. Smart money will play with you. As soon as we broke 100 US dollars, then went to 110, 120, 125, 130. Oil came crashing down because a lot of retail traders bought at the top, bought high, not bought low. Oil is recorrected. Obviously, there's a lot of sentiment that happened in the last 3 or 4 days, probably, that has contributed to this drop in oil, I'm assuming. But, markets are still, bloody red, for the most part, right? If you look at the Asian session, we know that in Asia right now, specifically China, we've got massive COVID cases, dropping left, right, and center, which is obviously affecting sentiment, right? So just watch out for that. We should look at some of these Asian indices at some point in time. I don't know when, but at some point in time, we should look at them individually, and then we can go to our metals, right? Oil down, Brent oil still playing at $100, and people act like this is a massive shift in price, a massive shift from the crazy madness of last week's rallies, but this is still very expensive across the board. Right, and then how's gold doing? Gold is at 1933. So that tells you that we're still playing at safe haven flows, right? No matter what, so and so tells you, markets are still absolutely scared, right? And I think yesterday there could have been talks. I'm assuming you guys can hear me loud and clearly. No one has kind of like come back to say they can't hear me, so I'm gonna just move to give you guys the full screen. There we go. Right. So this is incredible, right? Platinum doing quite okay. Drop now, but doing quite okay overall. Gold still fairly high. Came back down. I can see. Palladium doing its stuff. Right. So the latest is Hong Kong drops as tech stocks fall. Oil prices down more than 5%. All of a sudden, you have to see. Before the war, no one would couple tech stocks. Tech stocks, this is the Hong Kong Hang Seng Index, but remember tech stocks, you're also looking at things like NASDAQ, right? No one would couple these things with oil. There was never a relationship between tech stocks and oil. Now there is. That's the power of sentiment. All right, now stock futures, little change as Wall Street awaits Fed rate hike, 16 or today, one of the two, but I'm pretty sure USD holds intense 7-hour talks with China, all right, America, China, about Russia and Ukraine. China's digital yuan could change the dollar in international trade this decade, guys. One day, I've done a good job, but I'll bring it back. I'll bring it back to the forefront, talking and understanding the lost decade, right? We are literally, I called this in 2019. I called it in 2020. Thank you so much, everybody, for the sound check. We are in the lost decade. And I won't lie. My commitment to the academy is so strong this year. And I wish it wasn't. I really wish I hadn't made all the promises that I'd made, because I really want to take about 6 weeks off just to come. It won't happen. I won't do it, but I want to do it. I want to take 6 weeks off to quickly go restudy the debt crisis. The debt crisis is one of capitalism's biggest crises that we're in, but it was this holistic, almost 3,000 page book that Ray Dalio wrote a long time ago, and many other authors around the debt crisis and housing crisis, off the back of 2008. And while we were away, it was a lot of traders actually, and a couple of senior traders who came down to Cape Town. And when everyone was kind of like talking about markets, I realized, I'm reading the headlines as I talk. Let's move here to Forex Factory. I realized that a lot of traders right now still have that mindset of this current crisis we're in, whether you're looking at COVID or you're looking at the war or you're looking at inflation. And by the way, there's a housing crisis at the background. You guys remember I spoke to you guys about Evergrande crisis and how it's going to trigger a global housing crisis across the world. The 2008 was a global housing crisis that crashed the markets. And a lot of people are stuck there, right? They're stuck there. Now, I'm not buying it. I don't think the crisis we have right now is like the 2008 crisis. I honestly feel like in 2008 was a supply crisis. And here, I think we're thinning out demand, and that's more dangerous. And for me, it really reminds me more of the Great Depression, so the 1935 lost decade. That's the 10-year a segment that I will be diving into studying. The problem with that is I've stolen so much time from the podcast, which is terrible. and I have to put a stop to that. I can't keep stealing time from the podcast, right? So maybe I need to sleep less, but be very, check this out, back to the moon. Yeah, man. Be very careful, guys. We're in the lost decade. It's not business as usual, right? And I'm going to guide you through this stuff, but I think the best platform for that is during my war rooms. All right. Right. So another ugly day for Chinese stocks. At the top there, we saw nothing much really. Right. Chinese is just, worries pile on misery because of COVID. China is dealing with COVID stuff. China refutes claim that Russia has asked Beijing for military help. I think they want weapons. I don't know if it's true or false. Doesn't matter. Oil is down over 4%. Great. Chatter of possible cruise missile strikes in Ukraine. Guys, cruise missile strikes are terrible. They are big. And the damage is just massive. Bank of Japan official says monetary easing policy to be maintained. Monetary easing. So it's like tapering. The conversations for tapering for JPY are starting, right? Remember, we got a target for interest rates might go up in October. So they might actually start easing, right? Slowly but surely. Might stop printing less money. You might start to see JPY strength is what this thing is saying. So once Japan sustainably, achieves the 2% target, you remember we didn't even talk about the inflation data that came out on Thursday last week. I haven't even looked at it because I was away, but I'm pretty sure it was high, right? I mean, we predicted that CPI would go up. I'm going to check if I was right. I really have no idea. Now, Bank of Japan no longer needs to maintain massive stimulus. They no longer need to print money. They no longer need to keep giving out massive stimulus, like what America said last year about America. Long-term rates will come under upward pressure, right? Remember, everyone is worried about inflation, right? BOJ will sustain massive monetary stimulus as it will like to take time to achieve its price target. It will sustain massive monetary stimulus. So we are not going to just stop printing immediately. We're actually going to slowly but surely start to ease out. But for the most part, we're going to sustain the economy with a lot of money. And what we want to take time to achieve our price target of 2%. Remember, this is the biggest country in the world that lends the most money, right? So they want to print a lot of money right now, but they need to balance that with the economy. Japan's economy is still halfway in recovering from 2020 COVID. Expected rise in Japan inflation, driven largely by the war, energy costs, won't lead to sustainable steady rise of the 2% target, right? So I'm just breaking this down, for those of you who don't understand the lingo, but right now, be very careful. That's kind of like bullish in terms of sentiment for the day, but in the long term, JPY is still going to sustainably fall until it's time for it to get back up. It'll get back up with the interest rate hike, so watch out for that. But that's not anytime soon, right? COVID, international flights will be diverted, right? So we're back to the 2020 playbook when it comes to COVID. Russia does not have moral manpower, right? So Russia is Russia losing the war? I don't know. I'm not a war expert. Don't care about perceptions of this thing. I think everyone should just stop fighting. Oil continues to drop, all right? Leaves rate unchanged, all right? Okay. China did not change its rates. Cool. Right. Okay. So let's move to the charts now. Now, what I want to do today, sentiment is on and off from what I can gather for the most part because there were talks yesterday, but then, no one is pretty sure what those talks look like. You can see for yourself. We've got, blood on the streets, right? Most of your tech stocks are down. As you saw, sentiment says also because oil is down, right? Your financial sector is a little bit okay, not much going on. Here's your energy sectors all the way here, bleeding right through. All right, so real estate, normal, down, consumer stuff, okay. And I'm assuming CPI had a lot to do with that. All right. Okay, so all that stuff is out of the way. We've done a sentiment check and we know price is riddling along usual. So I suspect today and yesterday and maybe this week might be a nice slow week in the market. What I want to do today is teach intraday stuff. I want to teach people, number one, the stubborn people. They're the stubborn group of people who think if they attend every single morning session and every single war room, they will understand market structure for themselves and they won't have to do the course. I have no problem teaching you. I just want you to know that's not how it works. I only have an hour with you here. My module 1 and module 2 are extremely long. My module 3 will shock you, right? There's so much information that one needs. But I want to show you a simple thing, just a simple thing that I hope will make your trading a little bit better. And I want to do that with a chart that we've been following for the last, 2 to 3 weeks on the 1 hour time frame. Here is Euro USD. The last time we spoke, I told you guys, let's go to the 1 hour time frame. I told you guys that selling here on top of a demand is a bad idea. I have myself on record. The stuff is on YouTube, so you can never say I didn't tell you this is a cowboy move. Right, whatever happened on the 9th, where was I on the 9th? I suspect I was already on the road or about to go to the road. Right, so Wednesday, Thursday, Friday, this was my MIA days. Right, so this happened on the 9th where I was with my last post was I'm locking profits on Euro JPY and we'll see how far it goes. Right, so all Euro pairs were going up and clearly this didn't work. If you sold, no one should have sold. You should have bought down here as we discussed, right, in the war room. But if you sold there, then yeah, each to their own stuff, right? And then this kind of worked, but burnt out. I had no intentions of. You guys remember where I want to sell in Euro USD, right? Further up here, anyway. So I'm still waiting to sell, but this was a clean buy trade for the day, right? So markets kind of tried their best to return somewhere here. Now I want to do something similar to back testing, intraday stuff. But I want to introduce, because I don't know if you guys understand what I'm doing in this hour with you. So in the Senior Traders Program, what I do is, and what we do is we meet almost every day, as long as my schedule allows, and I stream with them for about 3 hours. So that's 3 p.m. till 6 p.m. Or 2 to 5, just depending on when the New York market actually opens, different times of the year. And what we're doing is, there's about there are 108 senior traders, but on the live stream, we probably get about maybe between 70 to 80 people who attend regularly every day. And it's broken down to the stocks division, FX division, indices, and everybody knows what they're doing. It's not me teaching. We're just all looking at charts and just shouting out trade calls, basically. So it's a mastermind concept, right? Now, what happens is, why is it 3 hours? Because you need time for orders. I'm talking to intraday traders. I don't really find intraday trading that fascinating for me personally, because I've got a lot of things on my plate. But if you love it, I want you to understand this. The first 3 hours of every trading day are absolutely important. How do I know this? Well, number one, I worked on the floor. I worked on the floor for 2 years, so I saw it for myself. Number two, you can see it in the chart. First intraday live video. You can see it on the charts. You can see how markets open and close on the charts. Now, what happens on the floor, right? Let's all pretend we're on the floor. And if I had my whiteboard out, this would have gone a bit better. Now, on the floor, especially in the trading pit, there's something called the trading pit. Everybody gets their orders for the day, and you show up about 2 to 3 hours earlier than the floor opens, and you see what wasn't sold, what wasn't bought yesterday. If you're a trader on the floor, there are 2 rules. Number one, you are not allowed to have a personal trading account. You get fired. You don't trade your own money. Number two, you don't make money by making right trades. This is what people don't get about supply and demand. I never got paid because I was the most accurate trader on the floor. I wasn't. No one cares about that stuff. You get paid per percentage points, sometimes cents to a dollar, for every order you get filled. You are pushing paper, pushing orders into the markets. You're filling orders. My job on the floor, or floor traders' jobs, is not to be right. We end up being right anyways because we have the most money in the market, and money moves the markets, not support, resistance, or your grandmother's indicator, just money. But you get paid because today you successfully managed to print and fill 25,000 orders correctly. Correctly means if I'm buying Euro USD, I have to, honestly to God, absolutely need to find someone willing enough, dumb enough to sell it. If I'm selling USD CAD, I need to find a buyer. That's how I fill orders. I fill orders from the pit There are traders inside who need to buy what I'm selling, and I need to sell what they're buying. But we also use retail traders. In module 3, when you get to lecture 17 or something, when I start to talk about liquidity, you will understand why this is so important. Now, you guys don't have all this information, and I don't have it anymore because I now trade digitally on the charts like you. What I want us to do today is to really get this. Let's really get this. So let's start from wherever the 1 hour time frame starts. And honestly, if you're not going to take the course, this is probably the only time you probably want to pause and rewatch this video and take as many notes as possible. Might not be enough, but it will help you. And I suggest you do take the course. Right now, everybody's paying for module 1 and module 2. Everything else is free. 3 and 4 are free because it took me so long to develop them. All right, so you really want to get in soon. Now, let's say we've identified, I'm going to scroll all the way back in time. We've identified from Valentine's Day, the 14th of February. So let's say we have identified a trend. So between Valentine's Day, from my own eyes, up until about the 23rd, right? And I'm going to mess up our chart. But I think this is a better use of our hour today because I still have to do a war room this afternoon to give you guys signals anyway. So just be patient with me. Right. Oh, yeah. By the way, I forgot everything's extending right. Let me just fix my rectangles. I don't want them extending right now. All right. So let's remove that. Right, so let's try this again. Right, so between 14th of February up until the 23rd of February, you don't have a trend. You have a range. I'll say that again. There's no trend. Your markets are not trending. We're looking at this historically backwards, but it's important, right? So between, I don't know if you guys can see this carefully, but everything in the white gray square, there's no trend. Markets are moving up and down inside a market range. And that's fine. As an intraday trader, you can make lots of money from that if you want, if you know what you're doing, right? As a swing trader, I don't care. I don't like it. I have to wait. I'm up red, green, red, green, red until markets break down to the trend. Now, as an intraday trader, you need to figure that out. Number one, the governing trend, right? And it's a good habit to look at the daily. It's a good habit to look at the weekly. It's a very good habit to look at the monthly, right? But for intraday traders, the weekly and monthly charts are so far away. They are pulling strings, but it's actually the other way. It's the opposite direction. For intraday traders, and I don't know if you guys have noticed or if you know this, for intraday traders, your multiple time frame process is actually fed from the bottom. You need a 1 minute chart to create a 5 minute chart, which creates the 15 minutes, which creates the hour, blah, 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 until you get to the monthly. For swing traders, we want to know what the governor is doing. So we use a top-down analysis in swing trading. We like to talk about a top-down analysis approach because we want to track the flow of money. Intraday traders create the everyday swing of money. So we need to kind of like do it a little bit in reverse. My take is always know what the hell the daily time frame is doing. And by that, I simply want you to tell me, look, right now, price has left or is leaving a daily supply to a daily demand, or price has left or is leaving a daily demand to a daily supply. If you don't even know what that means, you have to do my module 1. You have to start there. I can't even start to break that down. You have to be able to identify daily demands and daily supplies and be 100% sure on your speculation of the direction of price. At 365, price is not random. It is not random. I've spent my entire trading career proving that. Markets, players, market participants, aka human beings, are random. They're all random, but it doesn't mean markets themselves are random. All right, so be mindful of that. Now, once you figure out a trend, and let's say here we decide it's a downtrend. Let's say on the daily, on the 13th, 10th of February, it was clear as day that this uptrend was going to come to an end and markets were going to drop because on the daily, price had potentially arrived at a daily supply and markets were going to start turning. Daily supply probably being signaled by a peak somewhere here. I'm just making this up as I go, but it looks like that could be exactly what happened on the 1 hour time frame. And then you can see from that particular short-term analysis, EURUSD from Valentine's Day all the way till the 7th of March, which is approximately 3 weeks, was in a downtrend. Right. So now I know as an intraday trader, every single day I might be taking profits. I might hold for 2 or 3 days and turn into a short-term swing. I'm looking for sell opportunities. The next thing you want to do when you're clear on that, right? And this is what we do in the Senior Traders Program. And within the first 3 hours, you hardly, unless you're good, number one, and unless you do something that I don't even do very well, which is to nerve your tummy. You hardly ever want to open with your money. And that is to say, you don't always want to be the first in, man, with your cash. Let money move around. And so if we're looking on the 14th and price opened down here on the 1 hour time frame, I'm talking about 9 a.m. London. I'm in South Africa. So for me, that's when the London session would start. We can see that markets broke to the downside and then took about 3 or 4 days to get somewhere up here. Somewhere up here would be your focus. Somewhere up there surely will be what you're waiting for, because if we look back, and I don't want to waste time, but if I make this area red here, if you really just want signals today, this morning, you can even not even like the video and just try us again tomorrow. But today I really want to get this out of my system. I want to talk to you guys about the stuff, because I checked my module 3 videos last night, just trying to see how I labeled them to make sure if I taught carefully on this stuff, and I did. Right. So if you check on the H4, and maybe we can go to daily, but H4 is big enough for what you guys need to do. But if you check on the H4, there's definitely a supply. If you check on the daily time frame, the H4 supply, which is this red area, is nested in this nonsense here. There's a bearish engulfing pattern. Basically, it's connected to a daily supply that might have taken out a previous daily supply, which is what we said was going to happen, because remember, there's a downtrend up until the 7th of March from the 14th of February, right? So while everyone is screaming love, love in the air, Euro USD is falling, right? So we're clear about the path of price. Cool. So I'm going back to H4, then I'm going straight back to H1. And so up until markets come to a supply, number one, discipline for me would mean I have to wait. I have to wait for price to move up there, all right? Up this red zone, which is the daily supply, which was the H4 supply. So there I have confluence. That is non-negotiable confluence. The next thing you want to catch is one of these openings here, where price rallies into your area of value. If I'm understanding you right, mentor, for swing traders, we do MWT top down, but intraday we do reverse. All right. Thank you so much, Lincoln. I want to say yes, but I don't want to say yes. So for swing trades, you are 100% correct. MWD is our path. Governor, mayoral, daily, monthly, weekly, daily. MWD is for our path. We want to do top down. For intraday, we want to do a top down. All right. The top down is like this. You want to have daily H4. All right. You want to locate your governing move. And so you might have a daily supply, but you really want to find the order block that correlates with that, like something like H4. Because remember, I don't have a whiteboard open with me yet here today. What are you going to do in such a situation? This is the daily supply all the way up here, but price has already started dropping. You won't get confluence anymore. But now somewhere here, you've got an H4 order block, which is a supply. Price drops, gives you an imbalance, price comes back. You have, as an intraday trader, it's almost like you have no choice. You have to, if this is your bread and butter, you have to take this trade, right? Because this order block is almost in line with the flow of money from daily supply to daily demand, which is somewhere down there. But what I am saying is you want to investigate, and I'm going to teach you how. I'm going to teach you the reverse. You want to make sure that your 15 minutes to your H1 to your H4 is leading you up. You want to find retail traders. When you do reverse, remember, you want to sell. So if you're starting from the bottom, you're looking at buyers in this case. You want to see if markets have cornered enough retail traders for you to sell, because for you to sell, you need buyers. So look at this, right? The market's cornered someone here, right? So why on earth We know our daily is going to sell for the next coming couple of days. Well, you don't know that on the 16th, but we can see that from by the 10th, 9th to 11th, there's a big supply that has already started creating the sweep, right? This is a big leg, right? Market started falling here. All of this is just a simple retracement, and then markets continue to drop. If you do a swing low, swing high assessment of this first leg here, let's do it quickly together. You'll see, to me, it looks like a very fashionable retracement. Swing low, swing high. I put out my Fibonacci. You can see we're very much within that 50% golden ratio area. This is just a retracement. This red zone is a retracement from what the daily time frame has started. So you want to know all that basic stuff, your module 1, your module 2, how to use the tools, which I'm pretty sure some of you guys have mastered, and that's good. If you're new to how we trade, you want to quickly get on that stuff first. Right. So now, Mr. Mbasa, just come back to me, please, on the chat. Then let me know if I'm clear or if you've got a follow-up question. I'm happy to deal with it. I'm really going to take my time and teach a bit today within the hour. Right. So look at this. So now markets come back here, but markets come back here in the market opening, which means as an intraday trader, if it was me trading this thing properly, and I'm a professional intraday trader, my trading game is 8 to 5. It means on the 14th, 15th, I was not necessarily involved in EURUSD. It means I was trading something else, but it wasn't EURUSD. Because as an intraday trader, I know I can only sacrifice a finite amount of capital for a finite amount of time. That's the problem, not the problem. That's the pressure. There's no problem. That's the pressure behind intraday trading. It's finite capital for finite amount of time. As a swing trader, I can just chill and wait for price to accumulate, do wick-off distribution, and then roll with me. But as an intraday trader, you most likely want to clock out, on the day, most of the time anyways. Right, so markets rally into this area. If as a swing trader, you would know that, well, my entry points would have been put somewhere here, right? And I'd have been triggered. I'll have made $2, stopped, not stopped out, but back to zero, right? And then finally let price go down. But as an intraday trader, that's not good enough because my risk to reward ratio is fairly different. My areas of value are actually much smaller, and my entry points can be a whole lot sharper. Now, we need to immediately, as an intraday trader, you want to immediately identify opposing zones, right? You want, even as a swing trader, please, but as an intraday trader, every time frame that is an opposing zone is a threat to your profits. All right, visuals not clear on my side. What does that mean? Is it too small? Is it too small? Is it blurry? What's good, man? Mr. Mbasa, did I answer your question as well? Is that better, Alan? Just talk to me, Alan. Is that better? Right. So we're talking about this area here on the 1 hour. Right. So I'll just wait for that feedback here. Now let's cut all this stuff out because let's say on this day we were finally getting ready to get triggered, and finally we do. We get triggered based on a simple trade idea. We want to sell EURUSD. Markets come back to a valid supply. We have confluence. What's going on, right? Please, guys, talk to me. Visuals, questions been answered. Let me know. Blurry, still blurry. It's getting blurry on my side. Is anyone else having that problem? It could be your network, unless if everyone else is having blurry problems. Please talk to me. I am on fiber. I mean, I wasn't around, but I am on fiber. My son is at school. He's not playing video games, so it's not my network. Okay, answered. Thank you. Sorry, man. Sorry. I hope everyone else has got a clear picture. Alan, you might want to refresh, pause, and then rejoin us on the live there. Sorry, buddy. Right. So check this out. Markets hit supply. I want to be very clear as an intraday trader. Okay, thank you, Lincoln. Thank you, buddy. I want to be very clear. I think it's his network. Mine is clear. Fantastic. Thank you. Hey, Togozile, good to see you, man. Right. I want to be very clear about where I'm going to get off as an intraday trader. Intraday traders, your job is not to catch the biggest moves. No. Your job is to make the least riskiest moves and make whatever money you can make today and then make it as many times as possible. So on the 1 hour time frame, if you have the mind of a swing trader like me, I try to use the small entries to get maximum risk to reward and then turn them into swings later on. But it's a little bit of a complicated hybrid approach. As an intraday trader, you just got triggered here. You really should be thinking about getting out here, to be honest with you. All right, this is not really, I mean, there's so much to teach, right? This is not even a demand. Like, is this a demand or is it a pivot point, right? Demands are specific, right? Guys, remember, module 2 walks you through some rules. Rally, base, value, right? We want specific things in there. And then if this is a demand, you have to justify it. I would agree, but not really agree. But you're gonna have to do the 15-minute thing, right? So let's do that. But for now, I'm looking at the demand on the 1 hour time frame that caused this rally into a supply. And now I'm on the 1 hour and I'm thinking, okay, fine. The last time markets had enough buying power so that I can sell against these retail traders was down here. So this is my target as an intraday trader. Number 2, I then move. You can't take a trade from the H1 time. You can, but you're gonna have to grow into your trading by the end of the year to know that there's still a big, those are a lot of pips. This whole area, red area here, is a lot of pips to risk for an intraday trader. Intraday traders, you know, your areas of value are so finite. You guys see what that area looks like now on the 50 minutes time frame? This is not a demand. I mean, I don't know if I'd call that a demand. But we'll talk about these intraday levels. I mean, a lot of this stuff you guys don't know, right? But on the 15 minutes time frame, that 1 hour demand checks out. It's perfect. It's clean. It's everything that we know about in the textbook. Look carefully now on the 15 minutes time frame to the left. So you've got a 15-minute supply nested inside that H4 stuff. All right, I'm gonna stop using this highlighter because I want to be so precise with this stuff, right? So I'm gonna draw my usual rectangles. So this is all the intraday trader is thinking about. Let's make this supply yellow. You're done. Oh man, why did I delete that? Once again, I always teach people in the course, this is not a video game. I did not make this up. This is the markets. You're looking at it. If you understand the theory of supply and demand, you'll be so surprised. You'll be tired. You'll be so shocked how many times this plays out. What gets in the way is your psychology, which we'll talk about this much, right? What gets in the way is definitely your psychology. But in terms of price is so stupidly repetitive. Would this qualify as a good supply? Absolutely. That's a banker's supply. We see it. It's perfect. It's pure. It's the greatest of all kinds of imbalances, right? It meets everything. You want to talk about peak? Well, you got down buyers rallying into an H4 supply, into a daily supply, being based out and being phased in. You get a drop base rally, which is another type of supply we spoke about in module 2. Everything comes together here. Or you can just say we've got a bearish engulfing pattern. It doesn't matter. Right now, from this bearish engulfing pattern, as a trader, intraday or swing, it doesn't matter. We'll talk about this another time. It's very important to see how price leaves the area of value. You want it quick, fast, and in a rush. In module 2, when I teach you guys this stuff, I tell you that you want an area of value with a very tiny base, tiny to none. You want an explosion because that's smart money. Retail money builds up, waits for confirmations, blah, blah, blah. You must know who is trading. Is the smart money trading or in retail traders trading? You have to know the difference. I guarantee you, we know for a fact that retail traders are taught to wait for confirmation. So only after the big red candle did retail traders start to sell. What do we have? We've got a trap for them, a little box. You can see that everybody who starts to sell here after the big move, where's their stop losses? Right there. You see this? Retail traders always use for liquidity. Stop losses taken out, markets base out, and then push price up. Who are they breaking? Retail traders, once again, during the same day. There's no other reason for this movement to happen. There isn't a supply on the left for this movement to happen. If you go back to module 1, I teach you guys about turning points, original turning points. Who makes original turning points in price? The banks. The banks do. How do we know it's an original turning point? There isn't an opposing value on the left side to create it. There's no supply on the left for this turning point. There's those markets making sure they clean every single retail trader who sold low, not high. Once they do that, guess what they have now? They've created buyers. They've created buyers to do what? To sell from. Remember, we're selling, right? So then markets continue going down. It's a beautiful equation. It makes sense. It lasts for 3 or 4 days. Everybody who is smart enough makes $1,000, 200,000, 2 million, whatever it is. Who cares? Money moves for 2 days. You are not here as an intraday trader unless you're a cowboy. You would not have known that this was going to happen at 8:30 p.m. while you were asleep. 8:30 p.m. is prime time in the market. If you put your London open sessions, I do it very well for you in Module 3, you'll see for yourself. But that's pretty much just about when the London market is about to close. So the London session closes at 8 p.m. normally. London session starts at 9 to almost 8 o'clock. And when they close, the last hour of every trading day, orders are stacked for tomorrow. So you'll notice Nasdaq likes to move wild at 8 o'clock, 7:30. You just go to your charts. Just don't take my word for it, right? Treat me like a politician, right? Go verify what I'm saying. 7 to 8, you'll see there's always these weird explosions, slight turns, change of trends, massive continuations. It is the last trading hour where two sessions collide. London session is closing, New York session is continuing by itself. This is not you as a retail trader. It's definitely the banks. You would not know that they're about to do that right now, right? I mean, you might even assume that markets are going to fall into a demand here. So you and I are not in this move. Just like in Module 1 we discussed, we always let the banks move first. We don't ever think we are smart enough to guess or anticipate the banks. If you want to guess the probabilities of an outcome, you don't do trading, you go to a casino and you do gambling. In trading, we wait for smart money to move and then we know. Right, now there are many things that we can talk about here. We can talk about BMS, we can talk about break of market structure. You want to see that as a retail trader. You want to see a previous low being taken out by a movement that you have qualified as the banks are moving. You want to see a low being taken out by a movement, another break of market structure here. Only the banks can do that. Only they are the only ones with enough money and power and conviction to sweep the floor. What this does is they are making sure that markets don't come back and have any funny ideas to change the trend. They're taking out buyers. Importantly, in Module 2, when we're talking about market structure, if you want to go back to those lectures, we're looking at this stuff, highs and lows that are created with intention. When I start to break a low, and this is a higher low here, and I do this, I'm breaking this market structure. A low and a higher low presupposes or includes that we're going up, we're creating an uptrend. If I want to sell as a bank, I can't have money moving that way. I can't have money moving sideways because at some point in time, banks always run out of liquidity. They need you and me to make stupid mistakes because they know what they're doing. They understand what they're doing. Because we don't know what they're doing or understand what they're doing, they need to actually create an environment where we give them our money freely, literally. And so if you miss out on these cues, what's going to happen is at some point in time, they are going to create a market for you. We call that market makers, market making. They are literally going to create a sentiment. We want to sell. Therefore, we want retail traders, other banks, not just about retail traders. Everybody's competing with everybody. We want other banks to believe we are going to start buying. So we're going to switch up the orders. Division A, maintain sales. Division B, slow down on sales. Division C, take profits where you can. Division D, buy. This is all happening on the same market. One bank buying Euro USD, selling Euro USD, selling Euro USD more aggressively, and also taking profits in divisions. And then there are people like, well, this is what I do now for my trading flow. I manage the teams. I'm telling you, okay, look, man, I don't care what your plan was. Take property. I'm cutting you out. You're too deep in. There's a flow manager running the stuff with orders. Now, if you look at Euro USD falling, it fell day one. They took out whoever tried to join them here, right? Why? Retail traders selling here. What is liquidity? Liquidity is the money that you put in the market at risk, which is aka your stop loss, your $10, your $100, your stop losses. They take all of that money. Thank you very much. Create a buy market. Leroy, do you really believe retail traders would have started buying here all of a sudden after their sell stop losses were done? Absolutely. Why do you think that, Leroy? Because they do it all the time. Not only that, it's because that's what they were taught to do. Let's draw a big horizontal line here, right across. Geez, man, it's almost like I'm annoyed, but I'm not. I'm very happy to be doing this. Let's draw a line across. Let's squash this chart as quickly as possible and see. I mean, retail traders, if you're not part of 365, what does this mean? Is this not a resistance at some point in time in the charts that went down? And then was this resistance not broken at some point in time in the same charts? That price went up. And then when markets came back to this resistance, this is what they teach you. This is literally what they teach you. You guys don't want to do courses, you want to do baby pip stuff. This is what they taught you. And then markets came back to the exact same line. Then that line acted as a what? As a support. Once again, it acted as a resistance here, was broken up, and acted as a support. Interesting. And I can do this like all day, every day, go all the way back in time, literally see that they've been doing this at the same level with the same clients for years. Now, if we come exactly to where we are right now, this area here, the same orange line or pink line rather, where markets turn, and that is no longer, or it's perceived on the day. Remember, you guys have the benefit of hindsight. To you guys, it looks like it was easy peasy. Most retail traders, all they had was just this information in front of them. Markets came back to a support, but before it came back to a support, markets took out our sell orders. Therefore, it's time to buy. So what did retail traders do? They bought here because it worked last time, support and resistance. Where are their new stop losses? Here, new liquidity. Markets go up, you're up $10, you're up $5. You're now making up for the money you lost here, and immediately markets turn against you. A raid is done again. But wait a minute, Leroy, we can't be that stupid as retail traders. But we can. We are, most of us, generally, all the damn time. Look what they do. Goodness, if this is a waste of your time, once again, please go. But I guarantee you, I look at people's trading statements for a living. Professional and retail traders. I see this stuff every day. It's like it's a new thing. It's a new thing that sometimes when I start to do, I haven't done one-on-ones in a long time. And the call is coming out, by the way. But it's almost like I have to take painkillers, because to get through 20 trading statements and see the same thing over and over again is incredible. Why would anyone buy here again? Because this worked. Sure, their profits got snuffed out. But after all, the textbooks teach you that as long as support keeps being respected over and above, it gets stronger and stronger. And that's when they take you out. But Leroy, how do we know it was the banks that take them out? Well, look at the order block that gets formed right on top. Look at the order block that gets formed right on top. The very next day, you have a supply taking out a perceived area of buying pressure support. Markets give you this first candle, which looks like a rejection, a hammer, an upward hammer. Everybody's happy. What do retail traders love to do the most? They love to buy after confirmation. As soon as this green candle closes, orders are opening like crazy. Buy, 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 buy. What does smart money do? Takes you out. First, always finds your stop loss and then continues with its business because of your inability to read structure, or fundamentally, a lot of you, absolute stubbornness to think you can learn this stuff via PDFs written by people who call themselves King Pip and Forex Guru and Prophet Diaries and whatever else it is. This is not a game, guys. This is simply a banking thing that happens on a day-to-day basis. Now, as I conclude what I really want to show you, after you've seen all of this happen, you've seen structure being taken out, you want to start. This is, I'm saying, I want you to look for this all the time. I want you as an intraday trader to say, where on earth are the lost sheep going to buy or sell? You have to think like smart money. You make money when someone is wrong. Right? When I came to varsity, my first degree was law. So I first did my law degree before even jumping into the social sciences, because that's what I thought I wanted to do. That's what my parents wanted me to do. And I thought law was this cool thing where you argue your butt off. It's not anyway. It's not African law, and which is actually British colonialized law. It's really not about the intellectual debating. It's just about the confinements of legal arguments, which I found boring. I finished the degree. In the market, it's completely different. In the markets, there's no gray area. For me to buy, I need you to sell. For me to sell, I need you to buy. For me to make money, I need you to be wrong. It's that clear. As an intraday trader, you have to start thinking like that. You have to find, after you find the supplies and demands, go find retail traders in the charts. Are they here? Are they being stupid? Who's buying down here? Do you guys see a valid demand here? Do you guys see a bullish engulfing? Do you guys see any of my order blocks down here? No, you don't, because smart money isn't buying there. This is you have to see this stuff. Look at them. They show up, pump it up just to take it all down again. Consolidate here in case anyone thinks it's going to go up and then drop it. Now, what we want to do eventually is price drops for about 2 or 3 days, and then eventually, price comes here, which is where I want us to be today. So we would be entering here for the first time in this market because on the 15-minute time frame, confluence with the H4, H1 daily, we finally got a good sell order. Now, if you look carefully, you want to watch out for this. The reason why we meet at 9 a.m. every day is because we want to understand the orders of the day. How did price open? On the 16th of February, you and I would have had a very difficult conversation. On the 16th of February, markets opened with a demand, a strong opening demand. Why? Well, I guess to finish this trend here that was started or ended with the Asian session into the previous Asian is always at night, right? So between 6 a.m., 5 a.m., 7 a.m., blah blah blah, all the way to 9 a.m. markets open there. Markets here need to get to their supply to continue their trend, as far as I can tell. This is what I can see. When you look carefully as an intraday trader, because we've narrowed down our area of value, you have to learn how to do this. And that goes to that reverse thing I was talking about, right? Your target entry point for a good intraday trader, which will take time to develop, is roughly the 15 minutes chart. You really want to be good at that, right? 15 minutes. And to be honest with you, some people go as low as 5 minutes. You absolutely want to be good at that, right? But you start off on the 15 minutes time frame and you make some very clean assessments. You have to be absolutely brutally honest with you. And the questions you're asking yourselves is, can I take the risk? Number one, if I can take the risk, what does this mean, right? And as a retail trader, this is literally where you are right now. You have this entry point here. Your stop loss pretty much is somewhere inside this zone, right? Somewhere there. And I think if I was trading this market that day as an intraday trader, I'll probably have 2 sell positions. Position number 1 definitely is going to take profit here. When I take profit here, position number 2, I'm breaking even. Because taking profit here is me acknowledging the fact that this might hold. And if this holds, well, price is going to probably come back up, right? So I want to be in the clear, make money when I can. Intraday traders, you are not obsessed with long movements. A lot of you, after a year, listen to the words I'm saying, not after a month, after 6 months. Now, just depending on how much time you put in. I've seen people get this in 6 months, 3 months, but this has to be your life. A lot of you, look at this. This is 9 pips. It's a small area of value. 9 pips, guys. Look at 9 pips. Euro USD on 9 pips. I want to show you something. I want, because I type this stuff up in the public Telegram group. It doesn't even tell me how many people have read it. I don't even know who's digesting what information. I'm going to come to this calculator that I told you guys about a long time ago. It's just easier. I'm going to come to position size. I'm gonna ask it to calculate for me right now. Euro USD, 9 pips. You can see the last trade idea I used it on was yesterday's trade idea on AUD JPY. AUD JPY, by the way, I gave you guys this trade idea in the public Telegram group. That area of value was 8 pips. I'm using that 25K account, but remember, I'm only willing to risk 1,250 US dollars. I never risk the whole account. So I risk 5% of the capital. And then so guys, just so we're clear, this is my area of pain, my maximum pain. I'm not going to risk my 25K account. I'm only going to risk 5% of my 25K account, which is my maximum pain. It doesn't have to be 5%, sometimes like 6, 7. But I like only to lose 1,250 out of 25K before I have to reassess my life. I said 8%, and I said, how much is that? 5% risk of this, not of my capital, of my maximum pain, right, which is 1.2. And it turns out, if I take that sell on AUD JPY, I can use 0.92 lot size, almost a standard lot size, only risking 5% of 1,250 US dollars, which means I'm only risking $62. I'll repeat that again. I can almost use one standard lot size while only risking 62 US dollars on an account that's 25K, but technically, let's say an account that's 1,000 US dollars. That is wild. I am risking very little money while using a massive lot size for some gain. Right, so now let's come to the contemporary now. So I go 9 pips and I'm focused here on Euro USD. Do this every day with this calculator, every day for my swing trades, every day with whatever it is that I'm dealing with in the markets, every single day. And I think there is a massive advantage, a lot of advantage to you. Now, Euro USD, 9 pips. Euro USD, 9 pips. And let's go with, I don't know, let's go with a small account. Let's say you've got 250 US dollars in your account. I'm going to hit calculate. That's 13. You can go 0.13. We know that if it was a swing trade, 5% of 200 US dollars, if it was a swing trade, would probably only allow it to use 0.02 lot size. If it was a swing trade, or it wasn't an intraday trade, or the area of value was much bigger. But because on intraday timeframes, we are narrowing this thing down perfectly with correct MTA, multiple time frame analysis, we are narrowing this thing down, to its bits and bobs. We can go 13. And if you go 13 pips, 0.13 lot size, but you're going 9 pips here. So you got your stop loss above there, you're entering there. Then your first take profit distance is somewhere here. There's one price to run there for now. And you don't have to always take profit, although I would suggest on the first trade that you do. You can lock profits and trail stop and all that. It gets messy. But there, so you're risking 9 pips to get 22 pips. And I think that's okay. For intraday trading, 1:2 is not really a bad deal because we are always going to have opposing areas of values close by. I prefer 1:3, but 1:2 is not a bad deal. Here's the thing though, 1:2 is not a bad deal. You want to take out a Fibonacci between your entry point, right, to where you're going to take profits. Oh, but I'm going too fast. I'm giving you guys too much now. Please don't get confused. I'm not calculating Fibonacci levels. I'm not calculating a golden ratio. I'm simply tearing up this chart equally. Right. Now, I've moved from my entry point to my take profit zone for trade 1. If you see those signal service providers, most of them don't even know where this thing came from. They'll be like TP1 here, even though a price won't even get to TP1. And then they'll have TP2, and then they'll have TP3. This original idea comes from smart money. There's literally taking profits on the go, or another version of trail stopping. It means you've got 3 entries on any given target area. If you can manage your risks, because remember, this is already a big lot size, 0.13, and it totals only $12 of 250. So you have to make smart decisions here. Well, what does it mean? It means at 0.13 as a lot size, guys, if I'm going too fast, you just tell me, you slow me down. Don't worry about the time. I'll move a meeting for you. But I'm moving at this pace because it seems like everyone is with me so far. 0.13, which is the lot size, divided by 3, means I'm dividing this by 3 because I want to take 3 positions. I'm not going to go over. I'm not going to open 3 0.13 trades, because then that means I'm going to start risking something like $36 of 250. I only want to risk $12.50, but I'm going to go, and I can take 1 trade at 0.13, or I could take 3 trades at 0.04. Does that make sense? I mean, I don't know how bad the lag is on the live. Can one person just tell me I'm coming across clear and you guys are with me so far? Please, just one. If I can just get one, the power of one. If one person understands me, I'm going to assume everybody does. All right, I'm going to literally wait until you guys get to this part of, I know there's like a 10-minute delay, 10-second delay somewhere. Can someone just type yes or no if I'm coming across clear? I'm simply saying I'm going to open 3 positions, divide 0.13 lot size by 3. According to my calculator, it's 0.04, which means I'll have 3 sell trade ideas here. I just want one person to tell me I'm coming across clearly, please. Sell trade ideas times 3 in the same area of value. Each sell idea going for 0.04, which means all 3 would get, it's clear. All right, thank you guys, I appreciate you. Which means at the end of the day, I'm still using roughly 0.13, right? And technically speaking, if you do this 3 times, it's 0.12. So you could have 1 as 0.5, but just stick to that risk, right, of $12. You don't want to risk more. You will. I don't care. Someone asked me an interesting question. With 108 million 6-figure traders that I've taught before, how come I don't have 1,000 Instagram followers? It's because I don't do lifestyle content. And I don't care what lifestyle content traders do. I don't care about their lifestyle. You shouldn't care, because you don't know people's life stories, number one. But even if they got it from the market, you shouldn't care, because it's not gonna, my car is never gonna be your car. Their car, it's just, you need to care about your process. So you take it easy. It's the only capital you have. You have to protect it. I've got 3 good trades, 0.04. Now, what I'm doing here with the Fibonacci is I'm not trying to look for retracement levels. This is not what I'm using this tool for right now. You simply want to mark on the chart 50%. You want to mark the distance between 50% to your take profit, which I have here. You put the fib at the entry point and at the beginning of your take profit, 50%. You're telling yourself, look, man, if price gets halfway through 50%, I want you to know that it's up to you. But if you really want to master this intraday stuff, intraday trading is like playing rugby, but for the C team. Intraday trading is not the A team rugby, and I want to be very careful. I'm not trying to downplay the stuff. I'm simply saying, intraday traders, you should not care about perfection, about the perfection of the swing, about seeing price through to the end, about you know the stuff that I love, the stuff that I'm obsessed about in the war rooms, clean entries, perfect risk to reward, blah blah blah. As an intraday trader, you care about money, or you only want to make money. You're here to make money. So trade number 1, TP1 is here. I don't want to lie to you. As soon as as soon as I get halfway through, right? As soon as I get halfway through my original, remember, it's not like I've got, you can put the take profit there off the bat, right? Because you have to read your levels. But if my original destination of opposing I'm talking about supply to demand. Where is the next opposing area is here? Then take profit one. I'm out 50%. That's going to my capital. Thank you very much, because I'm going to need it tomorrow. I could be wrong today. Price could turn. And invariably, on the 50% mark between two areas of values, we go to 5 minutes, 1 minute, you will find areas of retracement. Look at this. There we go. This is on the 5-minute chart. There's a hidden demand there that might send price back anyways. So it is a good idea to start making money on the go as an intraday trader. Remember that. Right. So that's 15 minutes time frame. I'm going back to the 15 minutes time frame. Question: which is the best risk percentage? I'm Caleb. I'm stuck on 5% for retail traders. A lot of the time it's because they don't have big accounts. Thank you for that question. So it doesn't even matter what time frame. If you're trading between $100 to about $1,000 and you really want to make substantial money in the market, you're going to have to risk a little bit more. It's an unhealthy approach as a pro trader. I can tell you, for all my big accounts, I risk less than 1%. You guys have my trading journal. You guys are following that 25,000 US dollar account. You guys know for a fact, if you're in the academy anyways, that 1.25 is less than 2% of the whole account. And I'm risking 5% of less than 2%, because the bigger the account, and that's generally our rules. So if you've got a 10,000 US dollar account and up, right, you want to start risking 2% of your account, right? You really don't wanna put your markets on the line. But for intraday traders, swing traders, you're stuck with 5% until you can actually build your account up. Right, 5% is a lot in trading language professionally. I don't care if your forex mentors are using 50% of their accounts to make 2,000. I don't care, but 5% is actually quite a big stake already. So you really want to be very, very, very careful with it, right? So 5%, and then when your account starts to grow, you want to quickly drop that down because you already have leverage, right? Now you just need time to accumulate, right? Now, so TP1 is here. I've got 3 sell ideas running down there. TP2 would naturally be here if markets get all the way down there. That would be good. That's TP2. TP3 doesn't exist. You break even on the third trade and you just wait. Just wait. Because remember, if your analysis is right and you've actually caught the trend, right? Let TP3 run. At some point in time, we'll come back and lock profits. You see me, I post this stuff on social media every day. All right, I've been in the swing trade for 4 days, blah, blah, blah. I'm now locking profits. See you next week. And I keep it moving. Because what TP3 does, if it's right, if it runs, not all of them will run. Some of them will come back and break even. Some of them will trigger all your psychological insecurities, and all of a sudden, you'll see yourself closing that trade because, oh my gosh, the retracement became a reversal because you became a genius at predicting the future and you cut yourself short. TP3 does not exist. Now, let's see what happens here, and then we might have to call it a day. I hope this helped you. I hope this blessed you. Right, there's price. Price doesn't waste time. Take profit 1, done. You've made some money. Take profit 2, you see this. This is important. Look at it on the first 3 hours. Remember we said we're watching the first 3 hours of every morning or every afternoon, whenever you're trading, because you want to see the orders, you want to see the money. This is nice. This gives you confidence if you understand what's going on. You're like, wait a minute, what's going on here? So I was right that markets were going to bounce up at the 50% level. Fine, I took profit, but look at this. There's an order block, a bearish order block before we get to this destination. This is where traders start to change their plans. I'll suggest you do that later on in life when you're comfortable. The plan here is to take profit on trade TP number 2. That's the plan. But if you see something like this, this might signal that there's enough sell pressure, enough opposing sell pressure in line with the trend, the trend, to mitigate this area of value. Not only mitigate it, and by mitigate, I mean trigger, but also to exhaust the buyers, to break it, right? It's possible because of this. But also remember, guys, you're trading. You're not like watching Netflix and checking your phone. That stupid stuff that you see on YouTube, playing video games or checking your phone. You are at your desk trading. This is a job. It's a full-time job. Intraday traders, you're here. You have to think really quickly. You had 3 positions. You were risking 0.13 lot size. You have exhausted 3 of these positions to 0.04 each. But trade number 1, what has trade number 1 done? Trade number 1 has taken profit, which means you're now probably at 2% risk on a small account. You gotta put more risk back on the table because you're watching this happen. When this happens, I would, technically speaking, if I was watching it, open a new sell position here because you only have 2 running now. 1 has already taken profit. The third one is going to run forever, you hope. So you need a new one so that you still have, and so it's still the same lot size, still 0.04 running here. But if the opposing area of value is here, you don't have a clear take profit target yet. You can say something like this: look, this is a demand, I get it, but there's a lower demand. So what if price drives price all the way down to this lower demand and then I exit? Is that a good place to exit? To me, it sounds like it might be. You're not doing anything crazy. The most that will happen to you with your stop loss outside here is you're only going to lose partial profits that you made from TP1. It's numerical, it's mathematical. Nothing will change. If you're risking accordingly and you risk accordingly the second time, your capital won't disappear. You're only going to lose money, not your capital, but money that the markets gave you. All right. So we open a new sell trade here. Sometimes it works, sometimes it doesn't, because its time frames are flimsy. Markets drop, you see, pause, 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 pause. There, you would have been tagged. I would have still taken the risk gladly, but you would have been tagged, right? We're going to assume that markets are going to come to a higher supply. So that's where trade idea number 3 would have been. I still would have taken this gladly. There's just something about me and bearish engulfing candles. When I see them, I just can't resist, right? Let's see where price goes. You remember, TP1 is in the bag. TP2 has not been hit. Your stop losses are out here. I think this is one of those charts where price lagged the most. Pause. They knew you were there. Simple stop loss hunt. And retail traders love that. They love blaming market makers. Market makers stole my money. Market makers stop loss hunt. No, I think it's a little bit more detailed than that. It's not just a stop loss hunt, because a stop loss hunt is for liquidity. What are the rules of supply and demand? Sell high, buy low. So if you and I were paying attention there, that's all. Your stop loss was at the entry point of a fresh supply. So all price did was to lure us into trying to sell here. They want to go down and go up. So a trade number 3 been put up here, right? That would have done well because the stop loss would have been up there. Straight after that, I'm going to delete this now. This is TP1 from the previous trade. Your trade TP2, by the way, trade 2 is still at play. Remember, trade 1, 2, and 3 were all opened up here. Nothing has changed. TP2 gets hit, right, at 2 o'clock, basically on the same day. Now you've got TP1, TP2. Let's say you made a mistake here, took a sell, you lost a slight percentage of TP1, whatever. You still have a profitable day. If you're smart, supply and demand. I just want to show you what all of this looks like on a 5 minutes time frame. We really need to be an intraday trader. Check this out. Check this out. On the 5 minutes time frame, you would have known this is the better supply. It's clear as day. I mean, bearish engulfing candle. You see what I mean? There it is. There. The markets rallied in here to take out that silly sell area we're at. This is where price is. Then came down. This is clean, right? So I like 15 minutes for entry picture, 5 minutes to refine our areas of value. TP2 is done. Your trade idea has paid you. Entry point, trade idea number 3, you're breaking even now. Boom. So third trade idea broken even, and let's see what happens. Markets are deep in a demand, break the demand during the New York session, and markets run through the night and into the day. This is now the next day. There we go. This is like on the 16th. Oh, this is still on the same day. I apologize. Oh, 15 minutes. So it's still on the same day. Markets rally all the way up. You're broken even up there. When you break even, please just pretend it's okay for markets to take you out. Pretend like it doesn't bother you. Look at that. Markets came back here, but why? Man, I wish we had more time. Guys, look at this. Is this area fresh? Price comes back in here, markets run down, giving you take profit too. You have broken even here. Someone would have said, Leroy, might as well not have broken even. If I had not broken even, I'll still be in the trade. Sure, I agree with that. Personally, I always break even because I never know how wild price is going to be. But markets come back to the same entry point where all of this started. We are still in a long-term downtrend. I'm just trying to clear the charts. I'm just trying to clear these two white lines, TP1, TP2 is what represent. Now, if you broke even, game over, right? Trade number 3, you broke even, you didn't lose money on trade number 3, you didn't make any money. Trade 1 and 2 were profitable. You start the whole process again. You do this on 3 or 4 charts every single day of your life, you will get really good at this, right? Markets will refine. Remember, you're opposing areas of value. What does this mean? It means there's no more real demand all the way down here. Markets have opened the door to go lower. And so if you are awake, I would not be looking at charts at 10 p.m. I would not know what's going on. But if you look very carefully, markets are getting ready. It wouldn't matter to you because you are a London session trader. So you're done for the day anyways, right? You've made your money for the day. Markets have broken you out. Mark the area of the chart, the most recent demand. All of these are taken out. It seems to me that markets created a slight basis point here at 4:30 p.m. and then markets rallied all the way up there. I'm just going to quickly do the next day, guys, and then I'm going to have to call it a day with you. Right, so markets are playing along. I want to get to the next day because the next day, pause. Look at this. Sharp. I mean, this is just disgusting. This is brutal, right? This is the Asian markets. What's going on? I said pause. Yes. Right. Check this out. Markets then drop even lower on the same day or in the AM, 6 a.m. So in the AMs, right? Making sure that this low is no longer a problem. Remember, price wants to go down. They take out a demand and they drop much lower back to where we drew this horizontal line. Remember this horizontal line from 4 or 5 days ago where markets created a fake support area to trap retail traders to go down. Price is back at that horizontal line and moves down. Okay, fine, there's a demand there, moves down to a demand. It's going to delete this horizontal line there, makes contact and rocks. But when you start trading 9 a.m. the next day, the very next day, look at how markets open. I'm going to delete all these things here, delete this. That's the take profit for the previous day that we no longer need. This is now the next day. Markets open up here at 9 a.m. and rally where? Rally into this sharp, ridiculous movement. Do you think retail traders at 5 a.m. were selling the living daylights out of EURUSD? No. What happens at 5 a.m.? 5 a.m. is the last hour of the Asian session. What did I say happens in the last hour of any trading session? Order flows are overpiled for the next day, for the next session, right? So clearly, if you just look at it, right, it's not a typical supply and demand type of situation. In fact, if you look all the way left, you'll see the last time we had a nice clean supply and demand was this bearish engulfing pattern, and markets have almost done their best to maintain that relationship. But this is really the area that I'm talking about, this extreme impulse. And also watch this, watch that. But now let's quickly drop to 5 minutes because remember, I want you guys to see clarity. The smaller time frames create this painfully clear clarity. This is what this 5-minute area looks like. Just want to quickly clear this up. I'm so sorry, ladies and gentlemen, but unfortunately, straight after this, I have to go before they drag me out of this place I'm recording in here. I've got 2 staff meetings that need to have happened at 10:15. Right. So look at this. We've got a bearish engulfing pattern here. And then we get a clean retest inside the zone. I don't know if you'd have been awake to trade it, but I'm just simply saying this is exactly what happened. Markets left, markets gave birth, order flows in this area drained, markets explode, clean imbalance to the downside. This is roughly 5 a.m. I'm not, look it up. I told you guys to download that FX. This is called FX hours, right? The Asian session, the Asian markets generally start to slow down around 6 a.m. Sydney, Australia closes at about 8 a.m. New Zealand is definitely China and stuff are done by 6 a.m. That's the Asian session. The last orders of the day pile up. Markets fall between 5, 6 a.m. all the way to the market opening 9 a.m. here, London session. And then what's up here? 10, 11, the first 3 hours of that trading day, markets make their way up. Now, what's this? Leroy, is this a stop loss hunt? Probably. But if you look left, wait, let's draw a horizontal line. If you look left, you will be surprised. The 5 minutes, guys, is notorious for whenever you get stopped out and price turns down before, make it a new deal with yourself. Those of you who are going to do my course in module 3, I teach you the stuff. Make it an effort to always go to the 5 minutes chart to see what happened. You see here, you would have believed you've been stopped out, but if you look to the left, you will always find a better supply, a better, higher supply. You see the wick of this bearish engulfing pattern? That's the high supply that markets will simply come into. Once again, markets are not that personal. It's not, I don't think no broker one. I mean, there's JP markets, obviously, those scandalous brokers. But for the most part, price wants your money, sure, but it will get your money using its rules. It's not going to get your money by playing dirty. That's all it was. There was a higher supply there, clean, fresh. That's the last thing. In small time frames, you want to be the first one. Well, in all time frames. In module 1, I told you this. So you can guys see, fresh markets come up here, fresh touch, order block intact. You can see, and look how big this area is. If you really want to get into intraday trading, this is your life. You have to be good at this. This is what a lot of people, call sniper entries, but I don't know if they know what they're doing. This area of value is worth 2 pips. 2 pips. EURUSD on a $250 count. You only want to risk 5% of the $250 count. Look at the lot size you can make. That's 0.62 on a $200 count. If you can see it, this area of values were 2 pips, and all price did that day was fall. You risk 2 pips, and if you just held during the day, and again, same thing, same rules, 3 entries. You break down 0.62 divided by 3, you get whatever number that is. Sounds like 0.20 per sell. 3 of them. 50% of your first order block, which is somewhere here. TP1 will be somewhere there. TP2, next order block. TP3, break even and let price run. Had you taken this trade on the 17th, right, which was the next day, this trade alone would have given you 1:14 risk to reward. My prayer, especially for those of you who unfortunately won't get to see the rest of module 3, my prayer is this video is enough for you to get cracking. That's my prayer. I really hope this helps. Please do stick around. I'll see you guys tomorrow for the next London session. This afternoon, I'll be dropping swing trade setups for the entire market during our war room. Thank you so much for your time. Shake my hand, everybody. I don't think I said that before. If this video helped you, please don't forget to like, share, and subscribe. Goodbye, everybody. I'm sorry I didn't do signals today, but I really want to see people really start to gravitate to becoming their own fishers, right? Money is everywhere. Money is hidden in these things. These order blocks are absolutely powerful. Supply and demand is sustainably powerful. It will never change. It's been like that for a very long time. Take special care, everybody. Goodbye. Have a good day. I don't know if I'll do a live recording. You guys will let me know if you want me to do it live, or should I just pre-record the war room? Just type on the group or whatever. I mean, I'm flexible with both. If I do a pre-recording, it just means you get it a little bit later, because if I have to get it recorded, then uploaded. For me, lives are easier because I don't have to do anything. But that'll be later in the afternoon, maybe 3 o'clock or 4 o'clock or something like that. Right, everybody, goodbye. Thank you. Thank you so much. Cheers, cheers.